Okay, we're live. But I think I'm not on my earphones. Okay, cool. Jared, you're on. Adding you now. Where are my followers?
Hello.
Hey, Jared, how you doing?
Good, man.
Good, man. We are still going to wait for some followers. At the moment, we don't have anyone watching. So let's see if we get some people on. I did tell everyone it's happening at 6.
Perfect.
But the cool thing is we also, it becomes a recording, an IGTV recording, so people always watch it afterwards. So we'll see if we can wait a little bit before we get cracking, and then see. How's your day been?
Yeah, good. Enjoying the
Cool.
weather.
It's been up and down. It's like it's been
Yeah,
cold and then sun's come out.
yeah. Hopefully it stays that
Um,
way.
yeah, which way, the sun or the colder weather?
No, 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 the sun.
The sun.
Need the sun.
Okay. Listen, I'm sure people will join because they'll be letting them know that we're live. So what we can do for now, before we get into the nitty gritty, we can maybe just go into some detail as to who you are, and what you do and what you know about investing or don't know about investing. And you can just do a bit of an introduction of yourself before we actually get into the nitty gritty, because if people would have joined us by then they can get the content. But in the meantime, let's just do an introduction.
Yeah, perfect, man. So,
Cool.
long and short of it, I've been in the industry for about 14 years,
Okay.
mostly on the private wealth and then partly in investments. So, I've run my own suite of fund of funds. I've had a private client book and just recently started a distribution company for boutique asset managers in South Africa.
So explain to people that don't know a distribution company for boutique asset managers, and maybe a bit about boutique asset managers. And so talking to sort of someone that doesn't really know the industry necessarily that well, we've got our sort of viewers and following are a mix of some people that do financial advice and planning, and then the consumers and the public that want to learn a little bit more.
Yeah, so I mean, it's basically we're doing a distribution, which is effectively marketing, sales and
Okay.
marketing for asset managers in South Africa that have a AUM slightly smaller than the big brand names that are known out there. So effectively what happens is your smaller asset managers don't necessarily have all of the teams and the resources that a bigger brand would have. So we do an
Mm.
outsourced distribution for them. So we'll
Okay.
take on multiple asset managers as opposed to them have an internal or multiple people doing their marketing and distribution.
Okay, cool. And when you say boutique asset managers, give us sort of a distinction of what you or the definition of what a boutique asset manager is, and what other types of asset managers does one get?
Yeah, so I mean, I think in my definition of a boutique asset manager is effectively somebody that's got the ability to be nimble and somebody that
Mm,
can move within markets freely. So what we tend to see is slightly bigger asset managers have a restriction. So, I mean, if
yeah.
they've got an investable universe that is within South Africa, the larger
Mm,
their assets, the less they can invest in. So just to put it simply, if you've got an asset manager with 200 billion, within certain market caps of shares within South Africa, they wouldn't be able to invest in slightly smaller shares because they'd
mm.
effectively just end up owning those particular companies.
The whole
And the
company, yeah.
last and the whole company. So the last thing an
Mm,
asset manager wants to do is to allocate, 0.1% of their entire book to a
yeah,
single share, and they own 51% of their company. So,
yeah.
a boutique asset manager is somebody that plays in an AUM space, which we kind of feel is that sort of under sort of 50, 60 billion,
Mm,
but a true boutique manager is actually somebody that's playing maybe under 20 billion.
Okay, so to break it down even more, and also not to mention too many names, but let's use a share like as something that people know, like Apple. So what you're saying essentially, if I understand it correctly, you're saying that a big asset manager that has that has a lot to invest wants to buy Apple at the beginning stages at a very low price when it was still a very small company, just listed, not big, and wants to buy Apple, they potentially cannot buy Apple and only buy Apple once it becomes a much bigger company, whereas a boutique asset manager would have potentially been able to buy Apple at an early stage and have the upside of that for their investors.
Yeah. I mean, it's not even necessarily the stage that their company's in, it's more their market cap. So, you'll
Their
find
market
there's
cap.
a lot of
But a
shares,
younger company would have a small
has a
market
smaller
cap
market, correct, yeah. But I mean,
because they
there's a lot of companies that are playing in that sort of small to mid space that have really phenomenal companies. I mean, they've got great management, the team is good. Those shares tend to do quite well, but because of the limitations from an AUM side, so from an asset manager's book size, they wouldn't be able to get into those shares. Or they wouldn't be able to buy a sizable amount. I mean, if you take like I used the example, a company with 200 billion under management, if they go and allocate 0.01% of their AUM to a company that's only got a market cap of 500 million, they're either not going to get a sizable enough exposure within their portfolio, or they're going to end up buying their company.
Yeah, because they've got so much to invest. The company is small, which is a small market cap. Yeah. They can only really buy such a little bit of that company, which won't even make an impact on the total portfolio.
No. Yeah, yeah. I mean, if a single share has less than 5 or 6 basis points, if that company gives you 30 or 40% returns over a 12-month period, that just doesn't add any value to your company, to your portfolio.
Yeah. So essentially, bigger asset managers own sort of like your top 40 on the stock exchange. Jared? You there?
Sorry, you're breaking up there, Elmo. Can you see me? Yeah,
yeah, I can see you now. Okay, so what you're saying is that a bigger asset manager is going to really just buy your top 40 on the stock exchange, essentially. It can really only play sort of with that space. I think we broke up again. You okay?
We broke up there. Yeah, all good now.
Okay, so a bigger asset manager is really only going to be able to buy your top 40 on the stock exchange, sort of.
Yeah.
It's not going to be able to buy the smaller.
Yeah, so I mean, certain asset managers will only really be able to buy, say, 30 or 40 shares with a sizable enough investment to actually get those returns.
Yeah, okay.
Okay, cool. The universe is small.
Let's roll it back a bit for the guys that don't know much about investing.
Perfect.
And say, what would you say is sort of a distinction between savings and investment? Last week, we chatted to a person that didn't really have much experience in investments, and essentially they were just putting money into another bank account, and that is essentially, to my mind, savings. Give me your sort of distinction between savings and investments.
Yeah, no, I mean, I agree with what you said there completely. So, I mean, generally what we try and say is, investing is a slightly longer term and savings is for slightly shorter term. So, if you wanted to put a deposit down on a house within a sort of, 12, 24-month period, you'd be saving towards that deposit. You tend to invest more towards longer term goals. So retirement would be one of those, or just unforeseeable sort of future investments that you want. So savings would be a shorter term investment.
So basically, emergency fund stuff, 6 months to a year savings, maybe even a bit longer, but for a specific goal that's not far into the future. But if you're looking at sort of a future goal that's got a longer time period, you would start investing. But when one says investing, what's also the distinction? Because if you're saving, you would usually do that like in a bank account. I think the other thing one would use is potentially a sort of a fixed deposit that's not too long, or money market. But with investments, what's the difference there? Are you just investing in a money market longer, or does it change?
Yeah, so I mean, obviously you could adapt that strategy. So I mean, you can invest in a money market or a fixed deposit type investment. But generally, because you've got a slightly longer time horizon, you can take a slightly higher risk profile. And
Okay.
I mean, in the investment world, generally risk is deemed as investments that are volatile. So if you hold say a share for a short period of time, there's potential volatility which could affect the value of that. If you hold it over a
Yeah.
slightly longer period of time, you just smoothen that volatility out.
And volatility, just sort of a basic definition of volatility.
So volatility is the movement within the share price. So it basically means if
Yeah.
you buy a share today,
Yeah.
volatility could ultimately mean it's worth 1 Rand today, 80 cents tomorrow, or
Mm.
1 Rand 20 cents tomorrow, depending on which way the movement of that share is.
Yeah, and certain things like the news seem to affect shares, for example.
Yeah.
So that could be a short-term volatility because of news and geopolitical events.
Yeah, yeah. There's a lot of
Okay.
fundamental reasons as to why shares and companies move.
Yeah. So I don't think we'll get into that, but basically you're saying that if you've got longer time, you
Hmm.
can take the risk of that volatility because over a longer period of time, you will get some kind of return on that and some kind of growth on your money.
Correct. Yeah. You generally you're rewarded for taking risks. So
Yeah.
shares, equities, property, preference shares, those tend to give you a slightly longer term return that is significantly higher than what cash will give you. Cash
Mm.
being money market, fixed deposits, that sort of thing.
Yeah.
But yeah, you've got to hold them for a period of time to get that reward.
And what would you say is the minimum time to hold a share, ideally, if you want to see some growth and need to go through short-term volatility? What would be the time? If you have X amount, then you can start taking some risk with parts of that money that you've saved.
I'd say 3 to 5 years. So, I mean,
Yeah.
if you diversify in your share portfolio, 3 to 5 years would be about right. If you're
Mm.
buying just a couple of shares, if you're just buying one or two different shares in, say, the same sector, then you could look at extending that slightly longer.
Okay. But you're saying that you shouldn't take that risk easily with too much of your money if you have less than 3 years for you
Yeah,
to need the money.
correct. Yeah.
Okay, cool. So if somebody has never invested before, how would you say they should start and what should they consider?
Yeah, I mean, there's a couple of different ways of approaching it. So, I mean, it also depends what they want to do. Um, so the first thing that I always recommend is try and figure out what sort of risk profile you want. So
Mm,
generally what we say is the longer time horizon, the slightly more risk you can take on, which we've mentioned previously. So if you've got a guy that's in his sort of, late 20s, early 30s, you've got 30, 40 years before retirement or before you're going to require that capital. You can
mm,
then start looking at a slightly higher allocation to risky assets. So things like equities, as we've mentioned, they bring on a slightly higher risk, but you'll get rewarded. Other things like property tends to be a longer term play. Um, the older you get or the closer to a retirement or an investment date, the less risk you should be taking on.
mm,
So what I would generally say is, if somebody wants to play in a, share portfolio, if they want to manage their own assets, then make sure you've got either a small allocation to that, you're not investing your entire pension fund in it,
mm.
or you've got a slightly longer duration. So that would be the one option, is to go and actually physically buy shares that you see are fit, and you can play around in that market. I mean, it's a great way to learn about volatility. It's a great way to see what happens within an investment, but there
Mm.
is an assumed risk there. I mean, you don't have the expertise of an asset manager or an investment, so you need to just take precautions with that. The other alternative is
Yeah.
obviously going through a financial services provider. So going
Mm.
through a IFA or a share trader or
Mm.
anybody that's got experience within the investment universe.
What does an IFA mean? Give us the
Independent financial advisor.
okay. And when you say independent, what does that essentially mean?
Independent generally means that they're not associated to a brand or there's no bias towards a specific brand. So the only reason why we say that is because you do tend to see these trends where a financial advisor works for a specific company. They'll then promote or sell a product that is exclusive to just that company, and you're missing out on the entire universe.
Yeah. So you're saying by having an independent financial advisor, you would be able to have a lot more options and a lot more access to different types of investments and different types of funds.
Yeah, well, you also get an unbiased view. So generally,
Unbiased, yeah.
yeah, there's these house views where a specific manager is going to talk to the products that they sell. So you're not going to get a completely open discussion with your advisor.
Yeah. So actually on that point, talking about an independent financial advisor being able to offer different things and not having a bias, it's quite a wide question, but what types of investments does one get in South Africa? When one talks investments, give us some examples of some of the investments people can have access to and should look into.
Okay, so I mean, there's generally two types of products that are recommended. So you've got discretionary products, which is an investment that's completely liquid. So you can invest in shares or specific asset classes, or you could invest in cash, and you can put it in today, take it out tomorrow. Or there's compulsory products where you actually invest through an investment vehicle, which is your general pension fund type investment, which most people know. You've got retirement annuities, tax-free savings accounts, provident funds, preservation funds.
And there's rules and limitations as to when you can access your money and how that works.
Correct. Yeah. Each product has its own set of guidelines. They tend to follow similar themes, but for the most part, there's different independent rules according to them. Yeah.
And just in terms of, so let's talk about a retirement annuity and a tax-free savings. When we say there's limitations and rules, why are they there? What's the reasoning for them having?
Yeah, so I mean, for the most part, it's a specific goal for the government to
Jared,
give some form of tax relief.
Connection might be a bit off there. Don't know if you heard my question.
Apologies.
You
yeah,
there?
I did. Got your question. Yep. Can you hear me? Yeah, can you hear me now, Alma? Yeah, I'm still here. Can you hear me?
Can you hear me?
Yeah,
okay, pause
got you.
Again. You there?
Yeah, I'm here. Can you hear me now?
Your connection's still a bit poor. Yeah, so in terms of when you say there's limitations like a retirement annuity or a tax-free savings, for example, where do those limitations come from and why are they there?
Yeah, so I mean, for the most part, it's because government's giving some form of tax relief back to the investor. So take a retirement annuity, for example, there is a tax relief to the investor. So any contributions into the retirement annuity to a certain limit gives that investor some form of tax relief. So the reason why they try and limit it or guide it is that at some point in the future, the governments and SARS need to claim that tax back. So they're just trying to control what goes in, control how much tax is paid back to the investor or saved by the investor so that they can limit that. Investments like the tax-free savings account, there's no restriction on taking the money out, for example, but then you lose the tax benefit.
And there's only so much you can actually invest.
And it's limited. I mean, all of these products do have a limitation on how much you can claim back.
Okay. So the way I understand it, and I just want to give the feedback for people out there so they also understand it. You're saying there's a set of rules that often government has imposed for a tax relief, and that's why there are limitations on these types of compulsory products.
Correct. Yes. I mean, some of the other sort of limitations are around the asset classes you can invest in, but that's more to control the assets and try and prevent any additional risk to the investor.
You're leading me into my next question already by talking about asset classes. So explain asset classes and how to use them. So you've mentioned asset classes now. So how would you explain an asset class? What is an asset class?
Okay, so an asset class is an investable universe of either products or available shares that an investor can invest in, and they come with certain risks. So, I mean, we've mentioned equities already. So that as an asset class would be listed shares on either the Johannesburg Stock Exchange or international shares. So, I mean, all of the asset classes I'm going to mention now are obviously available in the specific to South Africa and then global space. So the generally used funds within the collective investment scheme would be equities, so shares. There would be cash, which we've mentioned previously. Cash is made up of a whole bunch of different instruments. We generally call it fixed interest. So there's things like money market, which is used quite regularly. There's a whole bunch of other products. I mean, we don't have to go into all of the details, but they're effectively your slightly lower risk or high yielding or yielding assets. So they're attached to some form of interest rate.
Okay.
Property, which is normally within the commercial and less so in your residential space. So it's normally listed properties. There's bonds, so you get either government bonds or corporate bonds. Corporate bonds would be bonds issued by companies, and it's generally your bigger companies that are listed that do issue these bonds. And those are the ones that are most common within the investable universe.
Yeah. So you said cash, bonds, property, and equity.
Equity, yeah. And obviously that applies to local or global. So you can go and buy global bonds in, say, America, you can get US Treasury or wherever it is. Yeah.
So in each one, I think you can have an option of either local or international. You can get international cash, you can get international bonds, you can get international property as well, and you can get international equities, and then local, obviously.
Correct.
Okay. And what is this? I mean, very simply, what is the difference between all of those? Not in terms of physically, we know cash is sort of the cash that moves between people. Bonds are lending. It's government or corporates lending money out, the money's being lent to them by investors, and they're paying an interest on it. Property is listed property companies that buy buildings, commercial, residential, whatever, retail, and are leasing and retail and leasing those out. Equities are essentially shares on a stock exchange that you can buy, and you can get access to local and international companies. Now, that's a quick explanation from my side, but what do you feel are the differences between those?
Okay, so I mean, it comes back to the associated risks. So as we said earlier, if you were going to compile a portfolio of different asset classes, you'd need to take a look and see what your risk profile should be, and from there you would allocate to the different asset classes accordingly. So as we said, equities tend to come with a slightly higher risk. So would property. Bonds in a certain degree do have a higher risk to, say, cash, but in certain instances it might actually benefit you to hold those. So I mean, take a government bond, which in theory is backed by the government. If it's paying a better yield than cash, the associated risk could be much the same as what cash would be, but you could get rewarded for that. So
a bit more.
So they each come with their pros and cons. Things like equities and property come with slightly higher volatility than say your fixed income products, but there could be a significantly higher reward for that.
Okay, so you talk about risk. Is there anything else that you need to consider depending on the asset class that you're going to invest in?
In what sense?
Well, is there anything else apart from the risk you're taking that you need to consider if you're deciding should you put your money into cash, bonds, property, or equity, or the mix of those? Is there any other consideration you should have other than risk?
Well, I mean, time. I would say your time horizon, which obviously affects your risk profile. I mean, one of the things that we've often kind of discussed internally within our investment committees is, everybody deems equities to be, say, high risk. But if you take an individual that's slightly younger, cash could actually be quite high risk to them. I mean, take where inflation is relative to cash. If they hold that investment over a 20 or 30 year period of time, they're not going to get rewarded enough to cover inflation or the inflation that they necessarily need. So, risk is a tricky one. I'd say time's probably more important than the risk factor.
Yeah, and we did talk about it. We said that you shouldn't be looking at equities if you're if you need that money within like 1 to 3 years. You should only be looking at equity if you've got more time. And then if you've got more time, you will then probably be rewarded for taking the time and leaving your investment in that sort of investment.
Correct, yeah. And I mean,
Okay.
trying to blend it across all of those asset classes would give you an optimum sort of return if you wanted. It would give you some form of protection as well as some form of return.
Okay. And explain sort of asset allocation in those asset classes.
Yeah. So, I mean, the asset allocation would, once again, coming back to where we were talking about the risk factors, I mean, you know, the general rule of thumb is the closer you get to your retirement goals, the closer you get to wanting to exit out of that investment, the more you should de-risk yourself. So
Okay.
let's take an individual that's in their 30s. They could afford to take a significantly higher allocation to equities and property. So if they wanted to go, say, 75% or 80% exposure to equities and properties and 20% to, say, bond. As they get closer to their retirement, they want to start shifting from the higher risk assets to a slightly lower risk asset. So by the time they get closer to their retirement goals, they're less reliant on markets going up. So, I mean, what you don't want to do is find somebody retiring just prior to a market crash like we've just seen now with COVID. You know, you don't want somebody to be retiring or wanting to with a heavy exposure to equities right at that point of crashing.
Okay. I think you broke up a little bit there to the end, but you're basically saying that you don't want to be in a situation where you've got risky assets close to retirement and you end up finding that you lose your money just before you need it.
Correct. 100%.
Okay, look. Jared, you with me?
Yeah, I'm still here. Sorry.
Jared, you there?
Yeah, I'm still here.
Jared, can you hear me?
Yeah, I can hear you now. Sorry about.
Okay, you might be back. Okay, so
I think I am.
hello.
Yeah, I'm still here.
Are you back?
Can you hear me now? I'm back.
I can hear you now.
Yeah,
Okay.
sorry, dealing with the working from home crisis where everybody's using the internet at the same time.
All right. Okay, cool. I think we just wanted to end off that last one. You're saying that if you're close to needing your cash, like at retirement, you don't want to be in a situation where you're exposed to too much equity, and then you're exposed to like a market crash, like we saw with COVID, and then probably the 2009 financial crisis as well.
Yeah, correct. You don't want to be exposed to that volatility unnecessarily.
Yeah. Okay, so just in terms of what would you say are some of the pitfalls you should consider when investing? What are some of the things that you should look out for, especially if you're taking some of your own initiative? What would you say are pitfalls to look out for?
Well, I mean, I think the general rule is to try and avoid the scams. So, I mean, I
Okay.
see a lot of investment scams coming through all the time. I mean, to the extent that they're advertising on social media and whatnot. But that tends to be quite an obvious one, so people generally do stay away from that.
Okay.
One of the other things I see quite often is guys will go and invest in, say, shares. They'll go and open a share portfolio. They'll try and manage their own assets. they don't have the experience to do that. They don't have the skills to do that. So they tend to go and buy 4 or 5 shares that somebody's told them are good around a braai. And they wake up, 6 months later, and they've got half of the money that they started with.
Okay.
So they either don't diversify enough, or they just go and pick the wrong shares. I mean, it's quite simple to listen to somebody. They say it's a good share. They go and buy it without any research or any knowledge, and you get affected by that.
Yeah.
So those are the common ones.
Okay. Yeah, I mean, I'll give an example. I decided to buy some Steinhoff shares at some point. And actually, while it was already an issue, and I decided to take a risk. But the thing is, the amount of money that I actually did that with was negligible. It was a small amount, so I was willing to take that risk. But I literally am sitting with, maybe 5% of what I invested, because the share still took a massive dive below R1. And I think I bought the share at about 11 Rand.
Yeah.
So, I mean, but those are also sometimes good mistakes to make, I think.
100%.
So the trick is not to, put, 50% of your money into something like that, and actually just,
diversification is the key.
Take that risk with less.
Yeah.
Yeah, but what did you say, sort of, so I mean, I took a very small amount, but the bulk of my own money is, for instance, going into things like retirement annuity, because I'm investing long term, and then sort of, a diversified portfolio of unit trusts where I've got some money, as I said, that I don't think I need, and I definitely don't need it within the next 3 years. And I've put those into sort of a mix of unit trusts. But what would you say is maybe a good mix for a person to say, look, say they're earning 10,000 Rand, they've got expenses, and they've got, say, 3,000 Rand left. How would you sort of divide that money into the types of investments one gets? And not to talk exactly what you'd invest in, but maybe the types of investments, and long-term, medium-term, and short-term. Just a quick sort of idea of what you would do with 3,000 Rand if you're earning 10 grand and you're spending 7,000 on expenses.
General, more of a guideline. Governments kind of put out a figure of 15% of your annual salary is what you should be contributing every single year. So based on that, if somebody's earning 10,000 Rand, they should be putting at least 1,500 Rand a month into either a pension fund, a provident fund, or a retirement annuity. And that needs to be deemed for retirement. And I personally feel that number should be higher, but I do understand where they've kind of got those stats from. And that's there to try and provide for a similar lifestyle to what you have at the moment. So if you contributed, 15% to your salary from the day you started working, which is probably early 20s, all the way up until retirement, which is 60, 65, you should be able to earn enough from that investment to continue your lifestyle. I generally think that it should be closer to sort of 20, 25%, but obviously affordability needs to come into play. So if you're using the analogy that somebody's got that 3,000 Rand per month, at least half of that should be going into some form of retirement funding. I do feel that they should have some short-term funding. So, I mean, COVID's been a classical example as to why people need emergency
funding.
Yeah. And generally what we try and say is you need at least 3 months of your monthly expenses. So you don't necessarily need 3 months of your salary, but what we do tend to find is most people spend their entire salary, in which case you need at least 3 months of that. So, I mean, COVID's now pushing past that 3-month period. So guys that got retrenched in that, initial phase, they're probably now hitting the end of their emergency funds. So, try and build up sort of 3 to 6 months at least. And if you can build up longer, then great. We always try and suggest, investors keep in some form of discretionary capital. So like I said, discretionary being an investment that's got a slightly longer time horizon than maybe what your savings would, but it is liquid. So putting that directly into a unit trust, at least you can access the funds prior to retirement if you do need them.
Okay. But I mean, I think I would say, and tell me if you agree or not, but at minimum, 15% of your income towards retirement, and then have 3 to 6 months emergency fund for your expenses.
100%. Yeah.
And after
Agreed.
that, you can start looking at anything else.
Definitely. Yeah.
Cool. And the more you can put towards the retirement goal, more than 15%, try and do that.
Yeah. Yeah.
Yeah,
Closer to 20% would be better. But
would actually
obviously
be better.
you've got to have the affordability to do that.
And it depends, where you are in terms of your age and things like that, and when you want to
Yeah.
retire. Yeah.
Yeah.
Okay, cool. So I think the last question for now, because we try and keep it to about half an hour. If we go over, that's fine as well. Um, People often ask me, and I've heard people ask in terms of, should you save a lump sum and then invest, or should you start with recurring payments and saving with recurring payments, or investing with recurring payments?
Yeah, look, I mean, it's a bit of a catch-22 that, because, if you've got that lump sum to invest, then yeah, definitely invest lump sum. I mean, the golden rule to invest is start now. And I
Mm,
think if you've got that lump sum, rather put it in something that's going to give you a return, as opposed to just keeping it in your bank account where,
mm,
you're lucky to get 2.5%. So,
yeah,
yep, invest it. Debit orders and long-term recurring investments are definitely beneficial,
yeah,
because you can build up a sizable amount of assets quickly without even realizing it.
yeah.
So the combination of both is definitely good.
Okay. Yeah, I was talking more in terms of as someone that doesn't necessarily have the lump sum now, but is saying, should
Mm.
I put money in my bank, in another bank account, build up a certain lump sum and then invest, or should I just
Uh,
actually start investing with recurring payments?
I would start right now with a recurring payment.
Mm,
Like I said, I
okay.
mean, you're going to get a slightly higher return. And I mean, there's also, if you want to start buying into a volatile asset class like equities, as that asset is dropping and rising, you
Mm,
start buying the lows and the highs, and you get a better averaging.
mm.
So you average out higher than if you had just, invested in one single lump sum.
Yeah, I'll actually give an example of that. Something that I saw. Someone that decided to start making recurring payments into a unit trust before the global financial crisis, and that share ended up taking a massive dive. So if you had put a lump sum into that, you would have had 50% less. But because she had recurring payments, at some point she was actually buying the share at the very lowest price, and that actually, after sort of a 5 to 10 year period, her investment was actually great. She had still made good money by just investing the 100 Rand continuously.
Yeah, exactly. Yeah, I mean, when you start investing lump sums, you then time in the market, which is difficult to do. The
Mm,
last thing you want to do is invest that lump sum the day before the Steinhoff crash, for example.
yeah,
If you can pick the bottom every single time, then that's great. But your debit order effectively does that for you. It starts buying the lows and the highs, and your
yeah,
averages work out.
cool. Jared, is there anything else that you wanted to say and let people know out there about yourself, about investing, about anything that you feel they could gain value from?
Yeah, look, I mean, I think the main thing is, if you're unsure about it, speak to a professional. So
Mm,
find somebody that you trust, speak to them, get them to guide you. I mean, that's always going to be the best. It's exactly the same as if the plumbing in your house is faulty. You don't try and tackle it yourself, or maybe
mm,
you do, and at some point in time, you're still going to call a plumber. So,
yeah,
take a portion of that, play with it in a share portfolio, or play with it in unit trust yourself. But I'd say give majority of it to a professional.
cool. And then the disclaimer for this from both of us is that you should not necessarily follow what we've said here. You should take it and educate yourself and discuss it potentially with a professional. We're not essentially giving advice. We've just been talking about what our views are. And you should definitely consult a professional before you decide to actually invest on your own.
Yeah, exactly that.
Cool. Jared, thanks for your time. And it's been good. If we've got something else to talk about, I'll let you know, and we can have you on again. I'm having these every week, and we can maybe take some of the conversation further at some point. But thanks for your time. I do appreciate it, and hopefully everyone gains some value.
Great stuff. Thanks, Salmo. Appreciate it.
Good man. Cheers, eh? Bye.
Cheers, eh?